Hey everyone, my name is David Williams, Executive Director of the United States Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Funding Power Capacity Additions in Africa. We are grateful to our moderator, Dr. Anna Schwitzberg from IHS Markit, and our distinguished panelists for today's timely discussion. First, a little bit about the United States Association for Energy Economics. We are the largest affiliate of the International Association for Energy Economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services you can find on our website at www.usae.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We've allocated sufficient time at the end of this webinar to address your questions. And now I would like to introduce you to our moderator, Dr. Anna Schwitzberg, Director of Global Power and Renewables at IHS Markit. Anna, over to you.
Thank you, David, for the warm welcome. It's great to be a part of this webinar series again. Today, we'll dive into options for funding power capacity additions in Africa and how they differ or need to differ from what we've seen in the past. We'll start out with some short presentations followed by a discussion period. So please feel free to send questions at any point. As David mentioned, my name is Anna Schwitzberg and I cover global power renewables at IHS Markit. And in current and prior roles, I worked with governments in Africa and companies investing in the region. So this topic is close to my heart. And right now I'm joined by a group of folks that I can lose hours chatting with, and I have. So I'm really looking forward to sharing some of that time. On this webinar, and in the order they'll be presenting, we have my colleague at IHS Markit, Natsanet Tasfaye. She's an executive director for research and analysis in our economics and country risk group, and she leads the development of the Africa Risk Indicator and Horizon Scanning infrastructure. In addition to her many roles, she advises executives on market entry strategies for Africa, as well as consults African governments on leveraging natural resources for economic growth. And she has a strong background in urban planning, which is critical to many of the discussions in the energy space. We also have Mohammed Badizi, who's an advisor and an assistant professor of law at Penn State Dickinson Law, focusing on contract standardization and sustainable finance for energy infrastructure in emerging markets. He has contributed to a number of government guidebooks on energy financing, and I had the pleasure of collaborating with him while he was the senior attorney for energy and finance with the Commercial Law Development Program at the US Department of Commerce, where he advised over 40 countries. And rounding out our group, Philip Benoit, who is currently an adjunct senior research scholar at Columbia University's Center on Global Energy Policy, where he leads the Energy for Development Research Initiative. He has extensive experience working on Africa's energy issues, including 15 years at the World Bank and more recently at the International Energy Agency, and now with Columbia. And in our back and forth on past projects, we hit a lot of it's a small world moments, so looking forward to hearing about his experiences. Before the presentation start, I want to set the stage for this discussion by providing a few points that I hope will highlight why this conversation is so pertinent, starting with the fact that Africa is home to about 17% of the world's population. And the next 3 decades, the region is projected to account for more than half the population growth. And Nigeria is projected to be the 3rd most populous country in the world. There's about 230 gigawatts of installed power capacity available to serve the region, which accounts for only about 3% of global power capacity. The same share Africa had 10 years ago, and almost 20 years ago. And almost half its power capacity is in North Africa, despite over 80% of the population being in Sub-Saharan Africa. This is not to say we haven't seen growth. Power capacity in Africa increased by almost 70% in the last 10 years, and almost 50% of just looking at Sub-Saharan Africa. It's just that other regions are scaling faster, and electrification is not keeping up with population growth. As a result, electricity consumption per capita in countries like the US are 3 times that of South Africa, and South Africa is more than 10 times that of Angola and more than 25 times that of Nigeria. And it's the reason we're focusing this webinar on issues related to mobilizing financing for power. So I think it's important to start this discussion by looking through an economic lens. And for that, Natsanet, it'd be great to hear from you on what you're seeing in terms of investment risk and whether there is fiscal space to dedicate to power supply.
Thank you, Anna. Just get us going. Thank you, and I suppose I have the pleasure of setting the stage for Mohammed and Philip after myself, and looking at the continent and really starting from a lens of what is the outlook post-COVID, because we significantly seen the significant impact and cascading impact of the pandemic as it was spreading globally, and we saw that the impact on the continent was initially through the decline of commodity prices. So the sharp oil decline in March was what was the more significant story when we're thinking about COVID's impact on Africa, before you really started to see the cases reach the shores of the continent through tourism hubs in Egypt and South Africa. When we're looking at where the continent is today with regard to the virus, we see that while we've registered over 1.2 million cases on the continent, most of that coming out of Southern Africa. That's mainly due to the fact that South Africa is testing at a much larger rate than the other countries, and it speaks to limited capacity. Right now, you see that most governments are accepting the reality that while they're torn between saving lives and livelihoods, the general orientation is about opening up these economies so that they can ensure that livelihoods are not permanently eroded as a result of the disruption from lockdowns and wider economic disruption. And so this is really a story of when we're looking at COVID and its current reality within Africa, but then the legacy of COVID on the region. It's one about how much it has potentially derailed Africa's growth trajectory, the more promising trend that we've seen over the last 2 decades, and within that context of the Africa Rising narrative. And we see that the continent, while it hasn't had the same hit to its GDP growth outlook in 2020 as we've seen in other regions, it's still quite significant, and it's triggering the first continental recession that we've seen in over 25 years. So while not the worst performing region in the world, it's definitely one within the African context that is quite significant, and we would highlight that the risk outlook is quite high, as you find that countries are dealing with widening twin deficits and struggling to finance those gaps, and I'll go into that in a little bit more detail. I realize that we're talking about a continent of over 54 countries. There's a great deal of diversity in terms of market structure, peoples, political systems as a result. So it's not a universal impact, it's quite uneven. We can see that based on, if you look at it based on structure of economies. So here on the graph, you can see that I'm highlighting the differences here, or our economics group is highlighting the differences based on the oil exporters, notably Angola and Nigeria, versus those who have a more diversified resource base, like South Africa and Tanzania. Those that have more of a diversified structure generally between agriculture, manufacturing, and services, like Kenya and Senegal and Cote d'Ivoire, barely withstanding the impact, but you can see that have quite promising recovery going into 2021. And then indeed the countries, the smaller coastal and island countries that have been negatively affected and heavily reliant on tourism and likely to face some sustained pressure as that global sector is likely to face a more significant downturn, considering travel disruptions and concerns about the public health crisis and the epidemic. But while this is a context where we see that the impact has been most immediately through deterioration of fiscal and external revenues, you can see that it's compounded with the erosion of FX earnings. You can see that most of the emerging markets over this period saw historically one of the largest capital outflows as capital retreated to safe havens over the period immediately after the shutdown in the pandemic. And this is happening in a context, most importantly, where Africa has relatively historically high external debt burdens. So the problem, when you're looking at the equation, it becomes much more acute. And as such, we've seen that rating agencies, including ourselves, but others such as Fitch and Moody's, have flagged this with a series of downgrades that they've highlighted. And you find that, unfortunately, no African country sits above investment grade right now. And it's bringing greater attention to the debt vulnerability aspect. And this is the biggest weight on the government as they're looking at how they're going to stimulate recovery, let alone resume public investment programs, including the power infrastructure. In many cases, these have been suspended, if not permanently canceled. And why is this concerning? Because not only does Africa have relatively higher debt levels, external debt levels, but it's held by a different type of creditor group. Whereas previously we saw over the 90s and early 2000s, most of the Africa debt burden was held by official creditors. We've seen over the past 15 years a trend shifting, especially after the HIPC debt relief process, with most of the accumulation of debt thereafter within the private market. And so it means that as Africans are looking to create the fiscal space in order to respond with the agility and the speed necessary in the twin crisis of a public and economic disruption in the continent, they're unable to do so because it's not as straightforward as accepting some of the debt relief programs that have been extended by G20 creditors or multilaterals. For many countries like Angola, Zambia, Ghana, the majority of the external debt holding is held by private creditors. And as we currently see, the working group that is being organized between African finance ministers and private creditors is moving at a much slower pace, as creditors bound by fiduciary duties and other requirements are not going to be as willing or able to extend debt relief. And it leads to a more protracted renegotiation or restructuring conversation, which means that many African countries effectively have one hand tied behind their back, as they have these external debt obligations that they have to maintain, while also trying to use what limited fiscal space remains after the erosion of external revenues to respond to the public health crisis, and thereafter try to stimulate the economic recovery. Given the nature of the external debt burden, I just wanted to put it again in perspective. The external liquidity gap that we're looking at beyond 2020 across the continent is going to be one that's much wider than we saw after the global financial crisis. And it's very much due to the structure of that debt, as I just highlighted. And not to put a damper on the tone of this discussion, but really just to place this for further conversation, this is what impairs governments' abilities to continue with project financing as they have been prior to COVID-19. And without much relief or respite in this area, that's going to continue to be the case. So there's very much a role for private actors and domestic capital, which I know others will speak to later in the panel, in order to fill that gap when it comes to project financing needs. I previously alluded to it, but I just want to highlight again, this is a complicated fabric. It's different countries, political systems, economic structures. While I spoke about the risk environment and it being exposed to very high downside risks, I also want to highlight that it depends on where you are on the continent, what type of risk view that is. Using our risk spectrum here, looking at the operational environments, it just gives you a sense of that diversity on the ground. You have countries at the lower end of our spectrum in the blue, like South Africa, Senegal, and Madagascar. You have parts of countries that are significantly blue, like Ghana and Kenya. And then you have countries that have, for one reason or another, pressures, whether it's industrial action, insurgencies, or political unrest that may be affecting them. And you can see that in the deeper red bubbles. So it's important when looking at the continent to understand that while there may be some risks when entering that sovereign, based on project location or your counterparts and stakeholders in that project, these can be sufficient risk mitigators. So while it's important to be cognizant of the risks, they're not necessarily insurmountable. Thank you.
Thank you, Nasnat. I think that's a pretty good segue into Mohammed to speak to sources of funding and what they have been so far and what that may look like.
Absolutely. So I think I want to sort of tell a story one layer deeper than the one that Nasnat just described, which is, I would describe it as it's the wisdom and frustration of the African business owner. Let's just put that in context, and so we can understand the reality on the ground in some of these markets. Let me start by sharing my screen here. Okay, so let's just start quickly in a macro level. I want to describe the background before we get into the reality of what the operational burdens are because of energy shortages and the energy gap that Anna described in the African marketplace. Just to distinguish the investment flows into Sub-Saharan Africa from other, I would describe, peer markets. What you have in front of you here, I apologize, the text is a bit small, but let me just tell you the colors and the breakdown. In blue, you have an average of the amount of total investment flows into Sub-Saharan Africa that are derived from ODA, official development assistance, multilateral financing or other forms of, sovereign to sovereign or multilateral to sovereign financing. It averages about 36%. I mean, it has gone a little bit higher, it's gone a bit lower, but generally over the last decade or so, more than 1/3 of all investment capital flowing into the African market has come from, you know, official sources, from ODA sources. And that's a very striking difference in terms of investment reality compared to, you know, another peer market here. Let's just look at South and Central Asia for a second. You'll see here that ODA assistance is almost 10%, less than 1/10 of the total flow, despite the fact that there's a lot of similarities in population densities, natural resource potential, diversity of levels of economic development, etc. The reality that we want to start with is that if you are a business owner, if you're a corporate in Sub-Saharan Africa and you're looking for, you know, to tap into a capital pool, you're looking to tap into the investment flows into the marketplace, the reality is that more than 1/3 of all investment coming into the African marketplace is not available to corporates. Because ODA, by definition and by design, flows through the sovereign, it flows through the state. And so corporate entities in Sub-Saharan Africa actually are unfortunately facing a smaller capital pool, a smaller space within which they can thrive, you know, through borrowing and investing in investment, because of the nature of the assistance and the dominance of ODA funding into Sub-Saharan Africa. So we start with that one description. The one reality is that already African corporates are at a disadvantage because of a more limited capital pool and a more limited access to a deployable capital pool. Then if we go and look more specifically at the energy sector, you'll find that, you know, roughly 20% of all the ODA assistance, all the official assistance that has flowed into Sub-Saharan Africa in the last decade, about 20% of it goes into the energy sector. Now that's notable, and it's important because, as we all know, investments in energy have a general correlation with improvements in quality of life and delivery of government services, you know, lifespans, education levels, etc. So you can understand why a significant portion of development financing would flow into the energy sector in Sub-Saharan Africa. And if you actually look at it here, what's interesting is it's very concentrated from certain funders. The European Union, the World Bank Group, and IFC is part of that. And the African Development Bank, you know, make up almost 80% of that flow of ODA funding into the power sector. And if you take this combined with the description before, the limited capital pool, it means that a majority of transactions, in some marketplaces it's all the transactions, in some places it's about 60 or 70% of the transactions in the energy sector are somehow tied to development financing. And that's very significant for one particular reason. Most development financing, although it can be to a private party, it could be to a private developer to develop a power project, or even to a corporate to do some sort of, you know, a corporate PPA on-site or near-site development of energy infrastructure, it still has a sovereign component. Maybe it's a sovereign guarantee, maybe it's some sort of letter of credit, you know, payment enhancement, maybe it's some sort of currency, you know, protection. But nevertheless, the state has a significant role to play in all or nearly all energy financing transactions in Sub-Saharan Africa. So you have an environment here, just on these two facts alone, that describes a reality whereby the African corporate, even if they wish to be bold and innovative and seeking to deploy either their balance sheet or their ability to borrow to develop their own energy infrastructure, is hamstrung by the dominance in the marketplace of sovereign or sovereign-supported financing of energy infrastructure. So already you have a context, you have an investment context where the corporate has very little access and very little capability to play an important role in the marketplace. This is distinguished from the reality, you know, here in the US or in other developed markets where you have full deregulation in the marketplace, virtually no sovereign presence whatsoever. Or even if you look at other peer markets in, for example, in India, Vietnam, some other fast-growing developing countries, they've actually reduced significantly the amount of sovereign support and sovereign participation in the marketplace, especially the energy marketplace. But nevertheless, in Sub-Saharan Africa, there still remains a sovereign-focused development pathway for energy infrastructure. And let me describe to you now why that's a necessary reality, but also why it creates an unrealized potential for African corporates. What you have here, I think, maybe one of the most important, you know, facts that we can introduce into the discussion today. A lot of countries here, a lot of information. Let me summarize it for you this way. Most utilities in Sub-Saharan Africa have a negative cash flow. So if you look at the chart here, you see a combination of the OPEX, the operating expenditures, the capital expenditures, and then the dot you see is the actual cash collected, the revenue collected, from tariffs and other services by utilities. And so most utilities in Sub-Saharan Africa have a negative cash flow, and as a result, require sovereign support or just simply running at a loss and then just building up debt over time. There are a few standouts. You see Seychelles has a healthier outlook. Mauritius is not too bad. Uganda is the only one on here that has a clearly positive cash flow, and that's because they privatized their largest utility. And there was an investment fund, Actis, you might be familiar with, that came in and invested a significant amount of money to improve efficiency and delivery of services and revenue collection. And you can see the result of that. But as a result of this, and this has been a decades-long problem in Sub-Saharan Africa, of the negative cash flow for most utilities, there's been poor maintenance, insufficient investment in expanding the grid or expanding grid reliability, a new generation, as Anna described quite accurately. There's significant growth in generation capacity, but when compared to population growth, and more importantly, industrial demand, it is not keeping up, it's not keeping pace with the demand in the marketplace. And so this has created a reality where the African corporate, a business owner in Sub-Saharan Africa cannot rely on their utility for reliable service, cannot rely on there being predictable, available, and sometimes even affordable power to supply their operations, be it services, industrial, or otherwise. And this problem is quite severe. I mean, let me just describe, how critical the power shortages can be. If you look at the average number of electrical outages in a month, in places like Nigeria or even Tanzania, it can go anywhere from 10 to 35 outages in a month. And these are multi-hour outages. I mean, if you put the two sides together, Nigeria alone, which is, as was described already, the fastest growing population on the continent, shouldn't be and may continue to be one of the fastest growing GDPs, but nevertheless, there are on average more than 30 electrical outages per month, and each one of those outages can be more than 10 hours or more. Imagine how disruptive that is to the ability of a business owner, of a corporate, to effectively manage and plan out their operations, their manufacturing schedule, their service delivery, whatever it may be. And this, in a way, describes the problem, but I want to talk about the fact that there is a very large amount of wisdom now in the marketplace as a result of this reality. African corporates have learned to deal with this difficult problem. And this is really where I hope the conversation veers in a more positive direction. As a result of the significant power outages, there's been a fair degree of study of what this means in terms of economic losses, the cost of unserved power, the lost sales due to outages. And you see that on the left, very high in places like Angola, which you may recall from the last chart, has some of the longest outages. And those very same firms are investing in their own power capacity. So we're having a discussion today about, funding capacity additions in Sub-Saharan Africa. In a way, we need to be precise, because there's already been a significant funding of power capacity additions in Sub-Saharan Africa in the form of diesel generators. I mean, the corporates have not been sitting there doing nothing. Business owners don't simply see their lights go off and do nothing about it. African firms have invested billions and billions and billions of dollars in their own energy capacity in the form of a diesel generator. And you see those numbers on the right-hand side. The percentage of firms that have their own generation capacity, typically with generators, is more than 50% in a number of countries. More than 50% of business owners have installed their own generation capacity. And to the extent that Nigeria is the largest consumer of power generators in the world, largest importer of generators from China, for example. So far in this story, we've described this macro level problem where the structure of investment flows already cuts out part of the market to corporates. The fact that there's an inability to rely on utilities because of their negative cash flows and their inability to improve quality of service, and the burden on corporates in terms of the losses due to the disruptions and how much money they had to invest in their own generation capacity. And this is where the potential comes in, is that there is no business owner in the world who is more acutely aware of the importance and the necessity of focusing on energy costs, focusing on the reliability of supply, and being willing to invest corporate dollars in energy infrastructure than the African business owner. You have a marketplace that may have the greatest wisdom in the world the greatest potential in the world for the flow of capital from the corporate into the energy space because of this reality. And yet we have not seen that potential realized just yet. A few more things to point out. There's been a fair degree of study and a fairly straightforward conversation. We know that there's a significant power demand at the corporate and industrial level. You see some of the numbers here. Why do we know that? Because we know how much money they've already spent and how much demand they've already had to put on their own generation capacity through generators. We do know, and you see these blocks in blue, that because of the deployment cost and the installation cost of solar, that it is economically viable. That is, there's a positive net return over, a reasonable return period, 5 to 15 years, for CNI, for corporates and industrials to install their own solar capacity in a number of countries. Either you see Nigeria and Ghana, even Uganda, which has had a significant improvement. CNI investments are still rational. And so the economics are such, the cost of solar, the installation costs are such that now corporates have another option other than a diesel generator. Solar makes sense on paper. It makes sense on numbers. But what we haven't seen yet is the ability to connect corporate demand for energy, the ability to supply that energy through a new, more sustainable, more scalable energy source like solar, and the financing necessary to service that corporate demand. If you look at a chart of the acceleration in corporate PPAs over the last 10 years or so, you see a massive acceleration. I mean, year on year, a huge growth. Most of that growth coming from the Americas, and even within the Americas, it's within the US specifically. But what's really sad about this chart, and what's really unfortunate, is that there is no representation of Sub-Saharan Africa. And if you look at any chart for corporate PPA growth, not just this one from Bloomberg, you won't see Sub-Saharan Africa on there listed because the numbers are negligible. The number of corporate PPAs signed are virtually zero. In most cases, the largest consumers thus far at the corporate level, through PPAs have been breweries because they have a pretty, straightforward revenue flow and they're able to finance some of their installations, or malls. But even in those instances, almost all those breweries or malls are owned by foreign entities. And the financing really didn't flow through the Sub-Saharan, marketplace. It actually was sort of tied in through the parent company. So thus far, despite the massive growth in corporate PPAs globally, we have not seen African corporates play a role, tap into, or join that trend of corporate investment in energy capacity or energy purchasing through PPA. And I'm gonna wrap up here because I know we're gonna get into this in the questions, but why is this such a problem? Why is it that the disconnect between the willingness, the capacity, and the wisdom of corporates to spend money on energy infrastructure, but the lack of availability, the lack of liquidity of financing for those investments? Well, there's a fair degree of understanding now at this point that this is a significant and a dangerous development gap. If you look at these three blocks here, this describes the gap or the delta between energy investment as it currently stands and energy investment as needed to meet development goals as defined by SDS, or like the United Nations Development Goals. So in higher level, higher order, higher developed financial marketplaces, which is not just developed economies, but some developing economies that have fairly sophisticated banking sectors, there's about a 45% gap, and that's manageable. That's a scalable gap that can be realized, given that those are already fairly sophisticated economies. They already have the ability to undertake certain types of liquidity improvement or ways to accelerate deployment of capital in the marketplace. Then you have the middle tier, sort of mid-development in terms of financial sector development, about a 50% gap. Again, a challenge, but realizable because most of those economies are on a trajectory of increased lending and financial liquidity in the first place. But then the problem is at the very bottom there, and this is where most Sub-Saharan African economies sit, not counting South Africa and a few others, the economies on the continent that are most in need of an injection of financial capital directed towards corporates for them to deploy and realize their energy needs to address this this burden that they have of unreliable service. Those are the marketplaces that are least able to actually generate that financial availability, least able to service that demand. You see a 60% gap there. And that's projected that there will be, an inability for those domestic markets to generate and deploy enough capital to service installation needs. Now, this is not just corporates, this includes, broader installation of energy infrastructure. But if you think about the story now, if we go back to what I said in the very beginning, let's think about the African business owner and why they're both wise and frustrated. Again, nobody better understands, the economic consequences of unserved energy than an African business. Nobody is more ready to deploy and install and take whatever solutions from energy efficiency to co-location of solar, even sugar facilities doing, cogeneration in parts of Sub-Saharan Africa. Nobody's more innovative than the African business owner, but nobody is more hamstrung as well. There is no greater lack of the financial sector standing behind the corporate sector than we have in the African marketplace. There's no greater tragedy of a disconnect between demand and financing than in Sub-Saharan Africa. And I think that's really, if we share anything here today, that's one solution, one focus. And this is not billions of dollars in sovereign financing and World Bank deployments, just the ability to serve corporates with the financing needs they have. That solution alone would be a massive, massive sea change in funding this capacity gap in Sub-Saharan Africa. Thank you.
Thank you, Mohammed. I'm going to hand the baton straight over to Philip, because in this context, I think it would be interesting to hear about what the opportunities are going forward.
Yeah, great. So thanks a lot. I must admit that was a little depressing. But what I'm going to do then is actually maybe take a step back. Mohammed, I think you're still sharing your screen. But, and while you're doing that, I mean, if I could, I was very much struck by a slide that Natsanet put up on the issue of security. I started working on Sub-Saharan Africa in 1990. And I remember in the 1990s, I was at the World Bank, and something that a new line of work started, which was focusing in on the specificities of post-conflict countries. And I remember in the Sub-Saharan African context, really, when we looked at many of the countries, we were either looking at post-conflict, a number were in post-conflict, a number were in conflict, and another set were really in pre-conflict. And I think what's striking is when we now project 30 years later and just looking at Natsanet's graph that she had where she had different colors, what you really see is probably much less red than you would have seen 30 years ago. And I think in some ways that reflects the fact that we have been seeing some very important positive changes in Africa. And what I'd like to do, first of all, is just show you a slide that shows what has been happening in terms of GDP growth in Sub-Saharan Africa since 2000. Now, this is in PPP terms, and you see an economy that now is basically 4 times the size of what it was 20 years ago. And even if you look at it in dollar terms, it's at least more than $1 billion bigger if you take it as a group. And that is a reflection of the fact that what we actually have been seeing in Sub-Saharan Africa over the last 2 decades in particular is actual significant economic growth. And with that economic growth and that expanding economy, what we also see is significantly more domestic resources to draw upon. I think one of the issues that Sub-Saharan Africa has faced, and as we've seen in other regions, is sometimes when there's too much of a focus on foreign sources of income, it tends to undermine a lot of the potentials for growth, a lot of the issues regarding ownership and the like. So what is embedded in the figure that you have in front of you is really an expanding domestic economy. And so when we think about it, what is also embedded in there is obviously a lot of sources for domestic capital. Now in Sub-Saharan Africa, excluding South Africa, we actually see a relatively immature local banking market. It's, for example, as a percentage of GDP, it's half of what you see in Latin America. It's a quarter of what you see in Southeast Asia. It's very high in South Africa, but as a general proposition, it's low in Africa. And that means that there are a variety of untapped financial resources sitting in the economy that could be used to be mobilized to support additions in the power sector. And in that regard, I think it's always also important to remember the consumers, the customers, who ultimately have to pay for things. A lot of time we say, oh, well, you know, in poor countries like across Sub-Saharan Africa, they don't have the money to pay. Well, the fact of the matter is, as reflected in Mohammed's reference to generators, what we often see is that those customers are actually paying more per kilowatt hour than what you see in developed economies. So some of the issue isn't so much necessarily a lack of capital, but rather capital is being misused, misdirected because of inefficiencies. One of the big areas that we often tend to undervalue is this issue of internally generated cash, cash resources. And Mohammed also had a graph up there based on a World Bank study. And that's something I want to come back to, but just to sort of point out that the fact of the matter is these utilities, whether they're state-owned or private, sell a lot of electricity to customers, but they don't get enough money back. And in some ways, if one can improve the efficiency of these entities, we could see an additional source of domestic capital. And the last point I want to just make around this slide is the following. A lot of time there are discussions about the access problem that we have in Sub-Saharan Africa. The IEA projects that by 2030, while all the rest of the world will have achieved universal access, Sub-Saharan Africa will still be facing about 500, 600 million people without access. But the fact of the matter is, what we are seeing at the same time is access being provided to hundreds of millions of people. So there are two sides to this story. On the one hand, yes, the gap remains, but at the same time, what we are seeing is a significant expansion of the electricity system, and that was reflected in some of the data that Anna provided at the very beginning. Now, in that regard, it's sort of interesting. For example, if I said to you, oh, let's take Ethiopia, a very poor country, low GDP per capita and the like, they're planning on building a $5 billion dam. We'd all say, wow, how are they going to build that? They're probably going to need World Bank assistance and the like to build that type of dam. This is a picture of the Grand Ethiopian Renaissance Dam, which, if you see from the map, is located on the Blue Nile, and as a result has been extremely controversial. And the Ethiopians recognized from the get-go that they would have major problems in terms of raising foreign assistance for this. So as a result, they went to some non-traditional funders, including China, but they also raised several hundred millions of dollars from public sources at home. And in some ways, this also reflects the fact that when you think about in Ethiopia, and I had the honor to work on Ethiopia for a number of years when I was at the World Bank. What was surprising is you had a relatively efficient, in many ways, series of companies working in the electricity sector. Collection rates were high and the like, fundamentally a relatively solid governance structure as well. They've done some unbundling, which is designed to further improve the efficiency within the sector, very much remaining in a public sector context. But just sort of an illustration of the fact that when we're thinking about Africa, it's important to recognize that not every country is the same. And sometimes what people think cannot be done, in fact, can be done. I remember some discussions we had between the World Bank experts who were saying, well, this is our projection as to where demand is going to be. And the Ethiopian experts saying, no, you're basically undervaluing our expansion potential. And in some ways, I think that sometimes reflects a tension that exists, the cost of overinvestment, which tends to sometimes be a concern of external parties, versus the cost of underinvestment, the cost of unserved energy, which tends to be more of a focus and a concern for countries themselves. But if we look, for example, at another country in Africa, Democratic Republic of Congo, again, another dam, Inga, with the potential to provide electricity to all of Africa, 45,000 megawatts, so bigger than Three Gorges and the like, but still remains very much an unrealized potential. And one of the reasons is because of the overall country context. Corruption is a major impediment to investment in DRC as well as in other countries. The DRC has a lot of minerals, cobalt and the like, a big potential in terms of exports to establish commercial relations, but unfortunately, not enough of the money that comes in is really put to appropriate uses, and that creates a major impediment in terms of supporting investment, whether it's by the private sector, whether it's by foreigners, or even fundamentally, even within the public sector. And in that regard, it's important to talk about, again, this issue about internally generated cash. What we see with many of these utilities, going back again to the slide that Mohammed had, is inefficiencies in these utilities. But it's either a question of reducing commercial losses by improving payment systems, or reducing technical losses that exist throughout the transmission distribution system. These are ways to increase the financial wherewithal of these companies, not necessarily so much to attract private investors, but rather to generate more cash so that they have the ability to fund further capital expenditures and the like. We spend a lot of time thinking about how to privatize, for example, state-owned enterprises. The reality is, whether we like it or not, a lot of them are going to remain there. The World Bank and other international institutions spend a lot of time struggling with countries that basically did not ultimately want to send these strategic assets into the hands of the private sector. And we probably need to spend a little more time working with these inefficient public sector companies to improve their accountability system, their transmission distribution systems, to basically reduce financial losses, to improve their financial standing. And then the other thing too is it's important to recognize that when we're talking about, in particular, future energy investments, it's not all about large-scale, massive investments. Here's a picture of massive solar Noor project in Morocco, but there are a lot of smaller scale investments that will be required. The IEA projects that in 20, 30 years, the largest source of electricity generation in Sub-Saharan Africa will be solar. Obviously, we need to make sure that it can support companies and the like. But just to sort of say, when we come to those type of non-traditional renewables, it's often a question of smaller private sector companies that play a critical role. And then finally, in terms of thinking about where we may be going in the future, it's interesting to look at what's happened in the past. I think often of Brazil as a successful emerging economy. Obviously, it's had some problems over the last several years. Here's the growth rate that we've seen in GDP. And in green, we have the growth rate for Sub-Saharan Africa that has systematically been above that of Brazil. So part of the issue sometimes we have in Africa is an address issue. It was true, it's funny, 20 years ago, 30 years ago. It's still true today. It's a reputational issue, but I think we have a bigger disconnect between the reputation and negative reputation and the realities on the ground. There are a lot of positive things that have been happening in Sub-Saharan Africa. There's a lot of money in Sub-Saharan Africa to support further expansion of the power sector. Part of the issue is just doing a better job of improving the efficiency of domestic companies and doing a better job of tapping into domestic capital. COVID obviously is going to have a negative impact on Sub-Saharan Africa, as it will on the rest of the world. But just as we look to a recovery in the rest of the world, I also look to a recovery in Sub-Saharan Africa. And maybe 10 years from now, when we look back, we will see a region that is even bigger, much bigger. Why not the type of growth rates that we've seen in South Asia? So on that note, I'd like to stop and just sort of say, I think the future can be bright in Sub-Saharan Africa if we just think a little more about domestic empowerment and the like, rather than always focusing in on the negative things that have been happening. Thank you. Thank
you, Philip. Thank you, everyone. I'm just looking through all the questions, and I actually, on that note, I want to start out with one to Natsnet in thinking about, given the fiscal constraints that you mentioned, which very much is the economic reality, though, do we see, and which countries do we see investing in power right now, despite of those constraints?
Well, across the board, we've seen a number of countries, and this is again not specific to Africa, but many are rationalizing their spending because either their fiscal revenues have been eroded to the point where they have to, or the public health crisis is such that they need to redirect what resources are available. So as such, you see countries like Ethiopia with the GERD or Tanzania with Ziegler's Dam have fully committed to it. And so it's clear that those are the ones that have continued with that investment, because that is the flagship economic development project that the government has supported hitherto. So continuing on with that support. Whereas other countries have rationalized their spending and may have suspended planned allocation to power projects. That's indicative of the need right now and having to redirect resources, as I said, with the agility necessary, considering it is a public health crisis, rather than any greater indication of a lack of willingness to proceed. It's the utility, where we have seen, actually quite encouragingly, is much to Mohammed's points, governments recognizing that they don't have to be the entity behind tendering or driving a project. And that's something that actually you and I have been working on with our colleague Sylvia and the Renewable Service with regard to South Africa and opening up. So where they may not have put their money to it, you can see that they're putting their political will to it and revising legislation. But I don't want to speak on your behalf.
No, that's absolutely. And we have seen that, and it's interesting. There was a question here about PPA growth, and it's impressive, but it's small. And the question was, is it needed? Is it enough for meaningful electrification? I think what we have been seeing with our colleagues is that there is potential for it, because if you talk about large industries, if industries decide to share in projects that are off-site, they can be larger scale, and we are seeing countries start to really modify their regulation to try and allow industry to participate directly. And so there are those smaller projects that are on site that Mohammed mentioned as well, but also the really big ones, and there is some potential because in other countries, the PPA growth on the corporate side is large, and there are countries where it is larger than 20 gigawatts over a number of years. So that is something that's there. I'm gonna throw now, actually, on that note, in thinking about the differences between countries and where there's potential, there's a question here for you, Mohammed, because it refers to your slide where you showed OPEX, CAPEX, and cash collected. And it's about how much does that match up or is impacted by the supply mix. So are countries that are heavily coal-dominated or hydro-dominated seeing the cash collected more so than other, or collecting less cash than others?
It's a great question. I'll give you the simple answer and then sort of a slightly more complicated one. So the simple answer is that there's actually very little correlation between the energy mix and the negative cash flow in the national utility. And that's primarily because most of the losses on the balance sheet of the utility are coming from inefficiencies in the transmission or lack of receipts, as Philip mentioned quite accurately. They're just not charging anybody for power sometimes. And it's been a subsidized marketplace in many parts of the world, but continues to be in Sub-Saharan Africa. So regardless of what the generation costs are, hydro, coal, diesel, biomass, whatever it may be, the losses are fairly consistent across the board. Now, I will say, what you do see is in some markets that have a lower cost of generation, because of, fully depreciated hydro projects or whatever it may be, there's almost ironically a lower willingness to take away subsidies. It costs the government so little to give away free power. And it's such a political benefit to the next election cycle for people to not have to pay for power, that they're a little bit less willing and frankly, they're more able to continue the subsidy scheme. In the markets where you've seen sort of a healthy growth in tariffs, Ghana is a great example, Nigeria is another one. In Ghana alone, let's say, for example, the tariffs have grown at a fairly steady rate. I wouldn't say they're fully rational, but fully steady. As a result, massive influence and massive interest in private investment because of that healthy tariff scheme. And so actually to the point now where they've oversubscribed to new generation capacity. So the short answer to the question is no correlation, but there is a significance there. It does matter what the energy mix is, but it doesn't actually save the utility at the end of the day.
Thanks, Mohammed. Philip, I know you worked close with this on this topic as well. Do you want to chime in?
Yeah, what I would say is I think in some ways it has obviously a major impact on the nature of the capital expenditures, right? Because in particular, the countries that have wanted to go hydro, such as Ethiopia and other countries, dams are extremely expensive. They take a long time and they're extremely expensive. They don't have a lot of OPEX. And that's why it was interesting when on the graph that Mohammed put up there, Ethiopia had enough to cover some of its CAPEX and had relatively little OPEX, as opposed to some of the countries where they had higher tariffs, and that was often because they would have, for example, high fuel costs and the like. So there is a relationship in terms of how it plays out in terms of operating expenditures versus future capital expenditures and the like. But if I could just sort of follow up on this question also about access. There is a narrative that people love to put forward when it comes to Sub-Saharan Africa. It basically goes like this. There's a need 700 million people don't have access to electricity. the public sector doesn't have the resources to provide the access. As a result, the private sector is critical. We need to figure out a way how we can catalyze private sector investment. We need to make public sector utilities more financially robust so they can be an appropriate off-taker, a credit-worthy counterparty, and the like. That's all good, that's all true, except the fact of the matter is when you look at what are the companies that have provided access around the world, they're almost always state-owned enterprises. State-owned enterprises have been relied on fundamentally and primarily to provide access. That's true in China, that's true in South Asia, it's true in Latin America, and that has been true to a certain extent, to a large extent, in Sub-Saharan Africa. So it's obviously less true when we're talking about very home systems and the like, that as we think about in particular things like grid extension and providing access not only to households, but to businesses, it's very important to sort of recognize, as much as there's an ideological bent, I think, in the donor community to want to talk about private sources of funding, the fact of the matter is, at a global level, it's been public sources and inefficient public institutions that have been providing access. And my point there is, as we think about the issue about making the system more robust, and coming back to a point Mohammed just made as well, we need to think about ways of reducing technical transmission and distribution losses, increasing collection, there's overstaffing and the like. We need to be willing to spend more time to work with these state-owned enterprises that are critical to access and so many other things.
That actually, I think, feeds nicely into a question here about how can solar provide the same 24/7 service as a diesel generator. I think, Mohammed, that goes to some of the discussions you were saying about industry buying diesel generators, and I think feeds into what Philip just mentioned in regards to access versus reliable access and what is needed.
Yeah, let me just try to give that a quick answer, because I think there's a lot of other interesting questions. Philip said it well. Let me just modify and apply his logic. The corporate investment question is not an access question, right? Corporates and their injection of capital into the marketplace is not going to improve energy access in any of these countries. It's a reliability of service question, right? So these are already connected customers. These are existing consumers that have insufficient reliability and availability for their particular, industrial demand or whatever it may be. So their investment is going to be supplementary. Solar actually aligns quite well with the production schedules of most of these companies, whereby you can generate during the day and when a lot of their production schedule is. So it actually doesn't have to solve a 24/7 problem. It has to solve the why are the lights off and midday problem. And so in a way, the technology is actually quite well suited. So I don't want to suggest that I'm solving the energy access challenge. There is sort of a displacement effect whereby as corporates invest in their own capacity, it does free up more capacity on the grid to potentially serve other customers. And that's an interesting point. But I want to be very clear. I'm not suggesting that corporates are going to solve the access problem. They're going to solve their own problem, which is an availability problem.
Right. Got it. And that actually, I think it touches on, this is obviously a popular question because I see a few here on that note. Philip, there's one over to you in regards to how do you assess the potential of the African Union to serve as a funneling institution, either for security guarantees or for direct investment for projects on the ground?
I think here I'm sort of biased because I worked many years at the World Bank. I worked at the IEA, so my father worked at the UN, so I tend to be a multilateralist. I think those type of organizations have an important role to play in helping to create cooperation among different states and to help basically lift all boats. How effective it can be, I think what we've seen, and it's been a very interesting transition, let's say over the 30 years I've worked in Sub-Saharan Africa, is a shift from the importance of ODA to the importance of private investment. I think the role that these type of multilateral institutions, the African Union, can play in terms of helping governments to improve the environment for private investment is also critical. And this comes back again to something I mentioned at the very beginning regarding the slide that Natsanet had on security. Personal security is critical to making people willing to invest, as well as legal predictability and the like. So there's a role there, but I think national governments ultimately have a bigger role, and how we can figure out a way of improving consumer confidence is extremely important. I just want to come back also finally to the point that Mohammed kept making about the corporates. I think it's very important to recognize that basically corporates in Africa are overpaying for electricity because of the lack of reliability in the system. They have to have a parallel system of generators behind them. And what that basically means is if you look at the overall economy, too much money is going to be paid per kilowatt hour. So improving the efficiency of these delivery systems actually will free up more domestic resources to fund the capital expenditures that are required for power additions.
Thank you. I think we have time for one question and probably only for a minute response from each panelist on this, but I think it's one that's worth noting too, because it comes back to the objective of this panel, and that is what do we need to see in the next 10 years that is different from what we've seen in the last 10 years? Because I think the effort on regulation, institutional strengthening has been there, but what really needs to differ? And it goes into a question here that I see on governance, infrastructure, and credible capital market development. So I'll start, how about in the order of presenters? So Natsnet, if you could respond to that first.
Thank you. When looking at the determinants of capital inflows, it's very much most critically around the pull factors. So the governance environments, the legal protections, sanctity of contracts. And so what we really need to see is African governments reviewing what their role is, not necessarily being an involved stakeholder, but more of a facilitator for these investments. And this goes into the regulatory environment for the power sector specifically. What are they doing to stimulate the deepening of fairly shallow capital markets throughout most of Africa? But also similarly, and this is where a lot of, following up from Philip's point, a lot of the support from African minilaterals, so the African Development Bank, Africa Exim, Development Bank of Southern Africa, is supporting these governments with their project preparation. So focusing on capacity building rather than direct project financing. And so looking at what could really move the needle, it's creating more of a facilitated space for the interventions that Philip and Mohammed have brought up.
Great. Mohammed?
So I would just emphasize that I think what needs to happen in the next 10 years is we need to stop looking at only half the problem. So I think Philip said this well, and Nathan talked about the risk factors, and they're important. There is a huge effort, through ODA financing to drive, capital in the African marketplace to eventually, get the markets regulated such that they're sophisticated enough or they're compatible where they can actually tap into global, capital markets. And that's great. We want Africa to join the global marketplace. We want it to be a healthy consumer and eventually exporter of capital. I think that's excellent. But we're ignoring the domestic consumer. And the problem there is that these are people who are already in the marketplace. They're already comfortable with all the risk factors that Antoinette mentioned. They're already dealing with all the political issues that Philip pointed out. And yet we are not serving their capital needs. And so funneling more of that ODA financing, or whatever the source may be, directly to existing corporates, not somebody you want to invite into the marketplace, somebody who's already in the marketplace, will have a massive effect. And I don't think there's enough attention on that. It doesn't tick the boxes of, money deployed at the World Bank every year. So it's not as a comfortable a conversation, but in terms of an effective solution, I think it's rather important and it's not getting the attention it deserves. So I hope that changes in the next 10 years.
Absolutely. Philip?
Yes, for me, I would say, and in some ways it's an old theme, but I think the most important one, governance. We have to improve governance in terms of attracting foreign investors, but also equally, if not more importantly, creating the environment for domestic actors in the system. And also we have to improve the governance of public sector actors, public sector utilities and the like. So for me, the biggest issue and most important driver in terms of expanding the power sector is actually something that extends well beyond the power sector. It's the overall issue of governance. And I think, again, when you look at different countries and which countries have been successful and which haven't been successful, you will see two related issues, governance and security. And sometimes those are related as well. So for me, in terms of an area of focus going forward, it remains very much on the issue of improving governance in these countries.
Absolutely. Well, thank you for the very thorough responses, and also within time. I see there, I know I'm still seeing questions come through, which is fantastic. If there's a question we didn't reply to, please feel free to reach out to the organizers. I'm glad we're having this much participation, and it's personally been incredibly interesting for me, and I appreciate everyone for joining. I'll continue to speak with you and work with all of you outside of this panel. I'm going to hand it back over to David.
Thank you, Anna, and wow, thank you to all of our distinguished panelists. I've really looked forward to this webinar, as you know, Anna, in working on a few other power webinars with you and colleagues, and we just scratched the surface. We could have this dialogue all day long. So many thanks for your participation. Those listening, please be aware that we have recorded this. It is available in open access format on our website. Later on this afternoon. We hope you'll share it with your friends and colleagues. If you're not a member of the association, please remember we welcome you to join. Please visit us at www.usaee.org. Thank you all for attending. Wish you a good rest of the day wherever this finds you. And I officially close this webinar. Bye now.
Goodbye.